In addition, all business owners need to have some sort of what's called exit strategy or buy-sell agreement in place for when they die. They need to figure out where this business is going to go. You can set up a buy-sell agreement to fix the value of the business within certain guidelines. And if there's a right of first refusal in the buyer of that particular business, then that agreement is going to set the value of that particular asset. And it keeps business control not only in the family, but within the grip of interested family members involved in the management of the business. So sometimes you use buy-sell agreements between family members. If you've got 4 family members and 1 or 2 of them are involved in the family business, you use buy-sell agreements to fairly fix that value. You can put somewhat of a discount or reduction in there without too much of a reduction, and the IRS will accept it. And you have to keep those valuations up to date. You have to review them every so often and update them. But if we implement that, then we can kind of have a set value on the business interests as far as the estate holder and spouse are concerned. And that will influence the number that we have to use to calculate federal estate taxes. In this particular estate, we still have some estate tax issues. So we're going to go one more step. We're going to look at charitable giving. And the primary use of charitable giving in estate planning is to eliminate federal estate taxes. Taxes are the primary purpose. Philanthropic motive is a secondary purpose. As estate planning counselors to estates, we feel it's our duty to be sure that the charitable giving takes care of the estate tax issue first. And we're most concerned about that issue as primary over the philanthropic issue. There are 2 types of charitable giving, 2 types of charitable split interest trusts. Within the Internal Revenue Code, this is as of the 1970s, the one is called a charitable remainder trust. If for a second you can imagine that every trust, if we have $1 in a trust, and there's 2 aspects to that asset. There's the principal of the 100 cents, and then there's the income that 100 cents generates. And in a split interest trust, we're going to take either the principal or the income and give it to the charity. In a charitable remainder trust, we're going to put an asset into the trust, and the estate holder is going to take back the income and leave the principal in there. When that happens, if they put the principal in, they get a deduction for the contribution at the time they put the asset in the trust. The asset can be held in the trust and it can be bought and sold at later time, and there's no recognition of capital gain, so it can be a very effective use of trying to get around capital gain taxes. But when the estate holder dies, then that particular portion is going to go to the charity. A second type of trust is called a charitable lead trust, and in a charitable lead trust, the estate holder is going to give the charity the income off assets in the trust for a term of years. It can be for a term of years or for their life. And then when that is over with, the principal comes back to the family. Now, in a charitable lead trust, it's possible, depending upon interest rates in the marketplace, which is determined by the IRS to be the midterm rate on 12-month treasuries. That's kind of an indicator of what the current interest rates are in the industry, but based upon that interest rate, you can adjust the interest rate that's paid out to charities for a term of years within a charitable lead trust so that at the end, by calculation, by a present value calculation at the beginning of the term, nothing should be left. But if we actually can improve upon that interest rate, we can have a lot left that comes back to the family estate and gift tax free. Another issue we have to, so it's a very effective device to eliminate eliminate estate taxes on portions of the estate in excess of those unified credits amount, and there's no limit to how much we can stick in a charitable lead trust or a charitable remainder trust. So that will allow us the opportunity to put an unlimited amount of assets beyond these unified credit amounts into a charitable trust and eliminate the federal estate taxes. So we can shelter $10, $20, $30 million worth of assets if the client is so inclined. That means that the heirs will share, in today's world, the unified credit amount. If they have a husband and wife, $3.5 million apiece, that'd be $7 million. They would also be able to share the life insurance amounts. But the portions in excess, they'd have to wait. Usually it's a term of 22, 23, 24 years where a low interest rate goes out to the charities, but at the end of that time, that excess all comes back to them estate and gift tax free. One of the important elements in there, as we've got up here on the screen, is that there's an unrelated business income. We can take a family business and put it into a charitable trust in the year the estate holder dies and eliminate federal estate taxes. We can design it to eliminate federal estate taxes, but if it represents more than 50% of the total assets in that charitable trust, the IRS looks at that as an attempt to run a business out of a tax-qualified or non-taxable trust, and they'll disqualify the trust if we don't find a way to reduce the total investment pool in the trust so that the business represents less than 50% of that pool. And one of the things we then use is life insurance to buy a part of the business back into the insurance trust. We'd use the life insurance trust with a buy-sell agreement to buy a piece of the business back so that the investment mix we have inside the charitable trust will not trip the unrelated business income rule. It'll be less than 50%, and our trust will qualify and will avoid the taxes, the estate taxes on the particular estate. In the slide, the flow chart we have up here now, you can see that when we implement a charitable remainder trust, we eliminate all IRS taxes. We will have saved this estate $4.8 million, which is a pretty substantial savings, and we've used the insurance trust, the irrevocable insurance trust. We've used living trust for both the estate holder and for the estate holder's spouse. And we've used a charitable lead trust to absorb. It's a contingent charitable lead trust. If the estate is exposed at all to federal estate taxes after exemptions, credits, and deductions, then that portion would be going to a charitable lead trust. And by setting the interest rates at in the right formulas, we're going to be able to eliminate the estate taxes at the death of those individuals. So we've essentially eliminated the estate taxes on this.